Hi, and welcome to Aldrich Wealth's second quarter investor update and market outlook. I'm Nicole Reich, director at Aldrich Wealth, and I'm joined by Darren Richards, our chief investment officer and partner. Darren, let's start off with domestic equities. So at the beginning of the year, had a little bit of a rough start, and then we had some positive returns. But when I'm meeting with clients, it seems as if they almost don't realize that stocks actually increased in value in the second quarter. Can you talk a little bit about why we have positive returns, yet more of a negative sentiment as far as investors go?
Yeah, and I think a lot of people are feeling that way. So the quarter got off actually to a pretty good start and finished fairly strongly. So the stocks were up, but there were some headwinds and some tailwinds that kind of mixed to cause feelings of a little bit unsettling, and people really didn't appreciate what we got. So on the positive side of things, earnings were great. Small cap, mid cap, large cap stocks all posted more than 20% earnings growth in the first quarter. And the nice part is it wasn't just from tax cuts. A lot of it was top line growth. So earnings expectations are going to continue to grow throughout the year. Another 20% expected this quarter and high teens for next quarter. So earnings look fantastic from that standpoint. The economy is doing well. The unemployment rate hit an 18-year low, 3.8%. There's actually more people, there's more open jobs than there are people looking for jobs. That's the first time that's happened in history. So the unemployment rate is going to stay low. People feel good. Wages are going to pick up. So there's a lot of positives in the economy. Manufacturing, services, small business, consumer sentiment. A lot of people feel really good, but there's a but. We had inflation pick up in the quarter, and inflation usually dampens down returns. We had the Fed raise rates a second time, and now they're talking about 2 more rate hikes. So earlier in the year, it was 2 to 3, now it's 4. So monetary policy is tightening, which can, again, put a little damper on stocks. We had some volatility, and it was kind of a strange volatility. We had about as many up days as we did down days. So we didn't really have a lot of positive momentum. We kind of had an up and down market. So that caused a little bit of that feeling of uneasiness. And then lastly, tariffs. Roughly $100 billion in tariffs have been implemented or will be implemented. And that had a negative impact. So you put all these things together. Stocks actually, the S&P was up 3.4%, but it was kind of a strange feeling in the overall market. Yet at the same time, it wasn't defensive. Small caps were the top performers. Small cap value up 8, small cap growth up 7. So small caps are a more aggressive asset class, and they actually performed quite well. And it was really the defensives and the areas of the market that were most impacted by tariffs that underperformed, whereas technology, again, performed well, energy performed well. So all in all, a pretty good quarter. If you annualize it, you're looking at double digits. But it just felt strange because we had some headwinds and some headlines that kind of detracted from maybe some of the positive sentiment.
Thank you. I'm sure investors will love to kind of have the numbers behind all of that. Let's switch over to international now. So for the second consecutive quarter, we saw that international equities actually underperformed domestic equities. Last quarter, I believe you said that was due to currencies. Can you talk a little bit about why this quarter international equities struggled compared to domestic equities?
Well, it was currencies again, but it was a different move. So in the first quarter, we saw currency appreciation overseas. So that was a bit of a headwind, particularly for the export type countries, as a higher currency makes it a little bit harder on the export side. What we saw in the second quarter was the complete opposite. The dollar appreciated over 5% against international currencies. So we had a strong rise in the dollar. So if you actually look at the international equity index in local currency terms, it was up 3.5%. It actually outperformed the S&P. When you adjust for the currency depreciation, it was down 1.25%. So really what you saw was reasonable returns for foreign investors, but when you bring it back to the United States, the currency appreciation of the dollar caused us to see a loss on international investments. So not great. What caused the currencies to fall was really a couple things. Interest rates in the U.S. are getting higher relative to international markets, and higher rates tend to attract capital, which tends to raise the value of the dollar. And we also saw the situation in Italy, where we had some populist officials elected, and the probability of maybe Italy defaulting on their debt or even leaving the Eurozone increased, so that put some weakness on the euro. And then Japan had really a pretty bad first quarter from a GDP standpoint, and we saw the yen depreciate. So it was really the depreciation of foreign currencies that impacted the international markets the most. And it's even worse if you look on the emerging market side, where you had an 8% decline in the emerging market index. And countries like Brazil, for instance, the real depreciated 17% in the quarter. So it was almost all depreciation of currencies. And again, that tends to be a combination of the tariffs kicking in and the thought that maybe some of these countries will be negatively impacted. Their currencies went down. Strangely enough, Mexico and China actually were among the best performers. But nonetheless, emerging markets are definitely in the crosshairs of this tariff talk. and it definitely impacted them negatively and pulled down most of the currencies.
Great, thanks. So tariffs we'll come back to in a little bit. I'm sure
We
people
will.
are interested to listen a little bit more about what you have to say on that topic. Let's shift over to fixed income, though. So the Fed raised interest rates by 0.25% this past quarter, and as a result, we really saw short-term rates move faster and move higher than our long-term interest rates, and that flattened the yield curve. So should we be concerned that we're seeing a flattening of the yield curve and that really long-term rates aren't responding to these Fed rate hikes?
I think we should be, but not right now. So we're still early on in this flattening process. And as you mentioned, the Fed raised rates, and that moves the short end of the curve higher. Generally, in a normal environment, rates move up together. But what we saw was, as you mentioned, longer-term 5-year, 10-year Treasury type bonds really barely moved higher. And I think what we're seeing is it's really an issue of supply and demand. So if you look overseas, interest rates are extremely low in Europe, in Asia, et cetera. Very, very low interest rates. So if you're looking for a safe haven investment, treasuries still look attractive. So the demand is there, and it's kind of keeping a lid on rates from rising because you have buyers out there, you have willing buyers that are interested in the space. So the yield curve is flattening, and that's normally bad because essentially when the yield curve flattens, what that means is the market is pricing in some sort of economic slowdown or recession where the Fed's going to have to start cutting rates. And when they cut rates, then the yield curve steepens again. So we're flattening, and normally you would say, oh, that's, the Fed's going to cut rates, we're going to see this happen. No other indicators indicate that we're heading toward recession. So the probability of the Fed cutting rates in the near future is very, very low. So I don't think you want to interpret the flat yield curve as the market being nervous that the Fed's going to have to cut rates. I think it's more of a supply-demand issue. And in that environment, rates moved up across the board, so fixed income didn't perform very well. We saw declines in most of the indices. The areas of the market that actually held up the best were high yield and floating rate because they have a higher yield. We saw municipal bonds actually hold up well because supply is so low. But for the most part, rates did move higher. I'm not nervous about the flat yield curve yet, but if it were to invert and we saw other signs that a recession was on the horizon, then I think you want to start getting nervous and playing a more defensive positioning in your portfolios.
Okay, more to come on that. Let's circle back to the tariffs and really honestly your outlook. So last quarter you said let's expect continued volatility, average equity returns, maybe even possibly negative returns as far as bonds go. We've had increased talk of, now we have the tariffs. How has that changed your outlook?
It hasn't really changed it. So if you look in the second quarter, we had increased volatility, modest equity returns, and negative bond returns. So we got kind of what we were expecting. And this was during a period when tariffs were being put in place and being discussed. So the tariffs might have pushed returns down a little bit, particularly in equities, but they didn't totally nullify the good economic data. So I still think the economy's in a great spot. And the question is, $100 billion in proposed tariffs versus a $17 trillion economy, is this enough to really move the needle and impact economic performance? No, but is 300 or 400 or 500 billion? Yes. So as the numbers start to get bigger, you want to be a little bit more careful. But for now, these aren't big enough numbers to really slow down our economy. So I think the same things we see, moderate equity valuations, good earnings, we're late in the cycle, the Fed's raising rates. This is a late cycle recovery where you'd expect kind of modest returns. You'd expect interest rates to continue to move higher, and you're going to have bouts of volatility. Every time we get a tweet that comes out that is a little from left field, or we see some additional tariffs, we're going to have that continued daily volatility that we see. So expect that, but I think we still have enough of the headwinds aren't strong enough right now. I think the tailwinds are still stronger, so I would expect equity markets to continue to move higher. And if the tariff discussions simmer down a little bit, international equities that have been getting hammered because of these discussions could really rally strongly because they still look fairly fundamentally sound, and valuations, particularly in emerging markets, are extremely attractive right now. So the outlook still is for modest returns, trouble maybe a little bit on the fixed income side, more volatility, but if the tariffs pick up, then I'm going to have to kind of rethink this.
Great, thank you, and I'm sure our investors appreciate your insights and find those helpful. And thank you for joining us for Aldrich Wealth's second quarter investor update and market outlook.